Welcome back to the Four Pillars of Investing. We are in the midst of our study on cash flow and positioning. We've talked a lot about leveraged positions now, and that one of the ways to increase the rate of return is to employ a leveraged position. The asset itself is only going to move so far. The house, the real estate, the business, that stuff's only going to move so fast and so far. So increasing our rate of return by decreasing the amount of money we put in, we're going to find that out to be a very powerful Warren Buffett type of math and a very, very strong truth. Before we go on, this is personally important to me as someone who is sharing their experience with you, my experience with you. This is Charlie Munger, who's Warren Buffett's business partner. There'll be a time, I'm going to have a lot of reverence here because there's going to be a time where someone watches this video and he's no longer going to be with us. It just happened with John Bogle in the last, these pillars of mentorship and pillars of teaching that have been in my life. So I have a lot of reverence for these guys. And this is my favorite Charlie Munger quote. I have this in my office. This is something that I frame and have a picture of this Charlie Munger quote. And he says, "If all you succeed in doing in life is getting rich by buying little pieces of paper, it's a failed life. Life is more than being shrewd in wealth accumulation." And boy, how true is that? What a wonderful quote that is. Let's go out of theater mode so we can draw a little bit, as I'm accustomed to do. And this is just a wonderful, wonderful way to start this off. Is what value you're giving. The more value you give, it makes sense, the more wealth you will receive. The more people you can lift and teach and touch and help and inspire. I think Bill Gates, there's a lot of hatred for the wealthy. They're just rich and all they care about is money. Can't argue with it. There are those that are there. But there are others like Steve Jobs and Buffett, like once you get a certain amount, like that is enough, and you start doing charity. And for Jobs, I think it was about building something better. It was like, can I build something better? He could have retired. Why not just retire and go sit on the beach with something with a umbrella in it and drink it? And so this idea of delivering value is very, very important for stock investors, because it is important for you to know that with all this algorithmic trading and all this crazy, I think that's what he's talking about is, algorithm. I don't know if he's talking about algorithmic trading, but there's an idea on Wall Street that's just, let's just trade these papers. I mean, if you're only going to own something for a nanosecond, you owned it for a nanosecond. It's legal. You made the money, but you really probably had a very short amount of pride in your business. At the Cashflow Academy, I have a business partner, and we care about our students. We care about this business. And I would rather, stick with it and have a mission that I think is worthwhile than just own this for a nanosecond and get rich. If you said, Andy, your choice is you can have $1 billion for a nanosecond, I might take it. I just might be that shallow, to own it for a nanosecond. But I think there's a part of me that says, but Andy, what about your kids? Is it just setting them up financially that you would do? And that $1 billion becomes less appealed because I'd have a failed life. And, we want to have something to put our stamp on the world, however large or small it might be. So we're going to start this idea of value investing with Charlie Munger. It's emotional for me to look at this picture of him because I just love these guys. They are just pillars in and of themselves. In the rental business, here we're offering value to people by giving them a necessity of life, housing. There's a couple ways we can own it. We could own it 100%. So I have real estate that I own 100% of, where the real estate is in a I shouldn't say that. My tax attorney would say, Andy, you have these in a revocable trust in which you are the beneficiary. So that would be a better way to say it, that you have some assets that are owned 100% by an irrevocable trust in which you are a beneficiary. So that would be a way to put that. there's also investment. So if I could just paraphrase that and say, look, I own it. Okay, let's just say that that would be a good way to look at it. I also have investments in which I'm part of a syndication. And notice the language here of these two types of positions, a 100% position of ownership and a partial position of ownership. Notice again the word positioning in the cash flow pillar. So what we do is, let's say here, here's Andy and Marcy, in my where we have all the ownership of this. And let's say here there's just all these other investors, right? And so what happens, I'll just draw these people in a nice huddle right here. So what happens when the rent comes in, we get all that rent. Well, here when the rent comes in, they're going to distribute this and like dealing cards. They're going to cut up the profits, and I get what's called a distribution. So, every month is the beneficiary of this. I can see where wealth has been accumulated by saying a distribution has been processed. And so money has come towards a beneficiary, or wealth has been built in that type of situation. Does that make sense? That money has been distributed among many, many people. But either way, you're still an owner, still offering value. So just because you might only own 2% or 5% of a syndication, of a 400 unit apartment building, maybe you own 8 units or whatever, you're still an owner. You're still giving value to people, and you're still getting a piece of that income being distributed to you, just like cards being distributed around the people at the table. Okay, now same thing. My sons wanted a business, and they had 100% ownership of their little business established in 2010, the little tykes at 4 and 5 years old, or however old they were. 100% ownership selling lemonade. And the idea of that business was to teach them many things: accounting, advertising, hard work, raw materials, cash flow, sales skills. And the number one thing we taught was value. That was the number one word in this business. It says, look, when people get this drink, what type of value do you want to give them? They said, we want the best value. I go, okay, then you have to charge more. You're going to have to charge more than the guy down there, 25 cents, because value is going to take time to build. So real lemon juice and real ingredients, and better than country time, a better value to justify the higher price. And it was value. And they had 100% ownership of that, so they enjoyed 100% of the sales. But if you want to be in the beverage business, I said, sons, you could also buy some Coca-Cola. And instead of trying to beat Coca-Cola, you could buy Coca-Cola. In other words, there's a chance, boys, that you could make the same amount of money without doing any of the work by simply taking this cash from your lemonade stand and buying Coca-Cola and becoming a business partner with Warren Buffett. Because every quarter they pay a dividend. And you notice distribution and divide, those two words, distribute and divide, very similar. This is real estate, this is business. And so here they'll become a shareholder along with Warren Buffett and really, really, millions of other people who benefit from these sales. So the idea that a paper asset is not real, I reject that out of hand. There are real assets. My mentor Robert has a book called Fake. It's very important to read that carefully, because there are fake assets, but Coca-Cola is not fake. You can drink it. You can feel the caffeine rush. Next to Apple, it's probably the most recognized brand in the world. There is brand equity there. There is real value. They control a lot. They sell a lot of drinks other than Coke. They have trucks. They have employees. They have IP. They have secret formulas. They are real. And when you buy a share of that stock, you are in every bit. Buffett did not get some insider deal on Coke. He just bought it. And he bought it retail. And you can see how much he bought it for, and how he acquired it. And so the idea that this is not a real asset is just silly. And if you look at Warren Buffett's actual portfolio, he was certainly on the inside and very shrewd in how he bought some things. But if you really look at what he owns, there's some businesses he paid retail for. Let me give you an example. this one's special to me. It's very special to me. I was in R.C. Willey's, the other day, and I'm talking to, some of these buddies of mine that are still there selling furniture. And the reason I know so many people down at R.C. Willey's in Murray, Utah, is that was my first job. And Craig Ney, he just passed away. He's one of my managers, so I got to mention him as someone I respect as my first boss. And when I was 12 years old, I put on my Sunday suit from church, and I walked down into his office. And he said, "Andy, what can I do for you?" I said, "Craig, he lived about, he was the manager of R.C. Willey's. His parents lived about 6 doors down from me, and so he knew my mother. And I said, "Mr. Ney, I'd like a job mowing your grass." He said, "Well, you look like a hardworking kid. We usually have someone from the warehouse do it. They don't like doing that very much. Tell you what, they'd probably love you to do that for us." So he started me off at $5 an hour, and I would weed and mow lawns at R.C. Willey. So I got to know him and the salesmen and the guys in the warehouse. And when I got old enough, I'd do deliveries when I was old enough to drive the truck, and that was my first job, was R.C. Willey Home Furnishings. And Warren Buffett bought that business from Steve Childs, or Bill Childs rather, and he paid a good price for it. And there's a great book called How to Build a Business Warren Buffett Would Buy, and he paid retail for it and bought that business because of their debt mostly. They have an R.C. Willey card, and people buy things on there and pay 20%. So that's a business, and it's funny because I bought most of my furniture there, and Warren Buffett has brought a lot of value to my life through R.C. Willey's. I'd say half the electronics and home furnishings in my house have come from there, and I've lined Warren Buffett's pockets and thanked him for doing it. It's a real business. It's not fake. Real business. I bought Duracell batteries. I do not buy Garanimals. I do not have any Fruit of the Loom underwear. Whoops, I don't have any Fruit of the Loom underwear. However, as a kid, when my parents would buy me the Tidy Whities, yeah, absolutely. Dairy Queen, I think I've kept that in business single-handedly with their blizzards. They're incredible. And, I stopped by at the Flying J and I fill up with gas, and my wife loves the Pampered Chef, and on and on and on and on and on. These are wonderful brands, and they've blessed people's lives with good, solid products, and they're real business. He owns 100% of these. He owns all of them. He is a major shareholder, and perhaps the greatest shareholder in a lot of these. Like, he's the largest shareholder of Coke, as we mentioned, but he's just a partner. And he bought this. He started buying this in the late 80s, mid 80s, when it was $3 a share, and that's what he paid for it. He just like you could have bought the same. You and I could have got it at the same price he got it at, and he paid a heck of a lot more for Moody's, and he got a great deal on some of the banks he's bought as an insider. Those were inside deals where he had warrants, and so those he did acquire because of his status. But many of these he just bought at retail, just like you'd buy them. And that's an important thing to understand. So that's like the ultimate asset column in the universe right there. If you're not a government where you can just print your own money and do whatever you want, if you're not a government or like a prince in Saudi Arabia where or a tyrannical, you are the government, right? That's like the ultimate income. That's like the ultimate asset column anywhere. And I would challenge anyone to challenge the reality of that asset column, because it's freaking awesome. And he's like, I wish I had his phone number. I would bug him all the time, because if I'd really taken the time to study what he does, he's the best. And he's got 90, I don't know how many $1 billion he has now to prove it. But it's an incredible thing. And he gets income from the sales of these. That's where he gets his money from, is whenever these guys do business, it lines his pocket. And so on this side, he gets what's called earnings. Earnings, or we might call it, watch this, we might call this net income. is, when all the expenses have been paid and all the debt and everything and all that's been paid, someone buys a Dairy Queen Blizzard, he gets paid, right, for it. He's a business owner. Okay, over here, he gets what's called dividends. Okay, and we'll talk about option premium, but he gets dividends, and that is cash flow. That's it. So people shun dividends because they don't understand the concept we just covered of infinite return. When a person understands infinite return, I think their view of dividends begin to change, because I'll share with you an idea here as we get into this on infinite return, is how do you increase the percentage? Well, let's say I buy a stock, or you know what, even better than that. Let's say I buy a house. We're not even going to talk about rent at $100,000. Okay. Well, there's a couple different things that could happen. Is the rent could go higher, or my cost basis could go lower. In other words, when you look at the calculus of this formula of V final minus V initial equals ROI percentage, right? Percent ROI. We could do two things. We say, well, what are the limits of V final? Well, let's say the limit of V final as it approaches infinity, would be infinity, right? The limit, there's no limit to the V final. The problem is getting a V final of infinity is hard to do, but that's what most people think. I want to buy Amazon, or I want to buy Google on the IPO at $80 and have it go to, infinity. I want to buy Apple cheap and have it go high. I want to buy Tesla cheap and have it go high. And what people focus on is finding investments where the V final is high. But we also know that the other limit that's better is if V initial approaches zero. When we take the limit of zero, then we get an infinite return. So rather than trying to find stocks that go higher, why don't I find stocks that pay a dividend that I can take my cost lower? Pause for a moment, and please, I hope you got that. In other words, you can try to take the V final higher, which you have no control over, or you can take the V initial lower, and either of these will increase the ROI. Either one. If you take the V final higher or the V initial lower, both increase your return. Well, how do you make something go higher? That's tough. But by reducing your cost basis, and this is what VI is this is cost basis. By reducing our cost basis, we can do some pretty impressive things. Okay, some pretty impressive things. So that's Warren Buffett's financial statement. Now let's talk about diversification. This is not widely diversified. In fact, there's something called the Pareto principle, where 80% of your money comes from 20% of your investments. This is not as large as some mutual funds, don't have this many investments in them. And so it's not as large as some sectors represented by an ETF. He doesn't own all the energy and all this. And so let's look at the percentage of what he's got here. And you have this 80-20 rule, like Pareto principle. 80% of the monies are made from 20% of your investments. So if you take the top 1, 2, 3, 4, 5, 6, 7, let's say, of his investments, okay, this is 75% of what he's got is right to about, well, let's just see, 1, 2, 3, 4, 5, 6, 7, 8. 1, 2, 3, 4, 5, 6, 7, 8, right there. So 75 to 80% of his money is right in that area right there, okay? And there's a reason for that. So, maybe some of these take off, right, and become like a Coca-Cola to him, or become like a Moody's or a Kraft Heinz to him, okay? For sure, right? Maybe that becomes that way. But it isn't like he's betting on Verizon. He's got, I think he's, of the billions of dollars here, I think he's got 50,000 shares of Verizon, maybe, is all. Maybe 50,000 shares. In fact, it might be only $50,000. I don't know. I'd have to go do the math. But he doesn't have very much Verizon. But he does have it for a reason, because if it takes off 20 years from now, it might make itself up into this area right here. So it's very important to understand this from a standpoint. Now watch this. Let's say you had an income goal of $100,000, okay? Or excuse me, an income goal of $1 million or whatever. And you want, or excuse me, 100 grand. So let's say that you want a passive income of $100,000 a year. You want to kick your feet up and say, look, that would at least get me out of the rat race. Guy gets $100,000 passive a year, I'm out of the rat race. Okay, great. Scenario one. Let's say you have $200,000 in the bank and you're getting 50% return on your money. That would do it. You're done. You get 50% on your money, you're out of the rat race. Done. Great. Go make 200 grand, stow it away, rock and roll, make 100 grand a year if your rate of return is around 50% consistently. And people are going to say, well, you can't do that. Well, his rate of return on his Coca-Cola dividend is 49%. Why? Because his V initial, his cost basis on that stock is $3.25. So that's exactly where Warren Buffett is. For every $200,000 of Coke he owns, he's getting 100 grand a year off it. Okay? And he owns a lot more than $200,000 worth. So his rate of return is 50% on the dividend, not the movement of the the movement of the darn stock. Warren Buffett is not caring about making Coca-Cola. He is a cash flow investor. He is like, that's rent to him, right? The cool thing is it's a lot bigger than a rental house. It's Coca-Cola. And this is power in that brand. Who would not want to wake up one day and say, congratulations, you're the only Coca-Cola? You're going to say, oh no, it's fake. I don't want any of that. So read my mentor's book, Robert Kiyosaki, Fake and Real, and understand the difference of what's fake and what's real, right? Warren Buffett's real. 401ks are fake. There's a big difference. Okay? This is a real investment, okay? It's a real company. Very, very, very important. I'm very impassioned about this. He's getting that return. He's getting it. He's getting 50% on his money just off the dividend. Why? Because the V initial was down so low. You see that? So, guys that fly around in planes and spout off on stuff like that, look, that's an awesome return. That's an awesome investment to strive for. Okay. Moody's. Okay. He bought Moody's, 20 years ago, probably somewhere in there. He paid $10 for it. He's getting a $2 dividend. That's 19%. So $500,000 cranks you out that. $1 million cranks you out that. And Bank of America was an insider deal. He had warrants, and what he did is in the crisis, he bought a bunch of preferred stock, and by buying that preferred, it gave Bank of America a boatload of cash. But with that, he said, I also want warrants that allow me to convert that to common anytime I want at like $10 a share, and then I can collect the common stock dividend. And so the cap on the preferred stock dividend had a cap of 6%. And he says, I want to be able to convert that to common when it makes sense and go from being a preferred stockholder to a common stockholder when I want to. And that was the structure of the deal with those warrants. So that was an insider deal. Not everybody got that deal. He got that because he was a stud. So let's call that what it is. That's an insider one. But nonetheless, they're paying 72% or 72 cents. And he was able to buy that at $7.14 and convert that preferred into common at $7.14 because of the warrants that he had. It was a coup, man. He just took over B of A and just was a stud. And, it's just how Buffett rolls, man. He's so much smarter than all of us. And he just is. He's just smarter than the rest of us. He's a stud. So when you look at that, that's the type of returns he's getting but what's the secret? Is it because Moody's went up a whole bunch? In this case, yeah, it's gone up quite a bit. Bank of America's gone up a little bit. Coke's gone up a ton. But it's the cost basis that he got. It's the low prices that he got on these really important brands that are huge. So in this journey, we're going to have risk management. But what I decided when I redid the 4 pillars of investing is I said, we're going to take a journey with Kraft Heinz. And that's going to be the stock we use with some others that we've shorted and other things. But I'm going to go with Kraft Heinz. Now, this is where that little talk I gave you at the beginning of this segment, or this pillar, is so important about not making a recommendation. This is an illustration of how someone might go about doing this. And we're not giving instructions to buy Kraft Heinz. You might be watching this 5 months from now. Kraft Heinz is a company that's in trouble right now. That's why I like it as an example. It's really gotten on my radar because they're in trouble. And 6 months from now, I might be out of it. 2 months from now, I might be out of it. Okay, if it goes really bad, we'll talk about that when we get to the pillar. But please, please, I beg of you, please, this is not something to just blindly go out and buy just because Buffett owns it. We're simply going to use this for illustrative purposes like we have in our disclaimer. In fact, it's important enough, I do this with trepidation because I know how people are. So many people want to fish instead of learn how to fish. And so this might look like a fish to eat instead of an example to learn from. So all of these specific assets, in this case, Heinz, stocks, in this case, Heinz, options, in case that's Heinz, and a transaction, in this case, Heinz, they are for illustrative purposes only. And I'll even throw this in. They may, which in this case is the case, and may not represent, which may be the case now. I might be out of it as of this viewing, of this recording. It may not represent this. In fact, we might use examples that are different or opposite than what we hold. Okay, so we're going to use this as an example here, and I hope you'll have the maturity to keep that temperament that I talked about in check. So let's look at this for a minute. Warren Buffett, his cost basis dividends. So this is really interesting stuff. Let's just look at a few that he owns at the top of this thing. Let's just look at some of these major holders up here. And notice there's a bit of a line here in the sand. I'm going to call these old, and I'm going to call these new. That these are relatively old and these are relatively new in Warren Buffett's portfolio. What a great portfolio to use to learn about cash flowing the stock market, old and new. And so right here, he purchased his first shares of Coca-Cola here in red after, and this of course has splits figured in, but his cost basis in this is $3.25 at retail. He just started buying it. In the 1990s, he started selling puts to buy more. His cost basis actually in 1985 is like $2.50. But over time, this is about his cost basis of what that's been as he's purchased at different parts along the way. He bought Moody's in 2000, and this has been volatile. I mean, look at this, clear from here to I bought it at $10. All the way up here to 70, all the way back down, all the way up. Of course, here you see the subprime meltdown having the effect on the market after 2000. And he's getting 20% on this, $2. Bank of America, he converted those warrants that we talked about in 2011. And, it's done pretty well. It's not great, but it's done pretty well. But it's not just the growth of the stock. I'm convinced that what Warren Buffett really likes are those types of returns off the dividend, that's been important to him passively. Now you'll notice his newer ones do not have this there because they haven't had time to grow yet. I'm going to speculate and say that if he bought these the way he bought some of his railroads, that his cost basis might even be lower than what it lists here. But this is his stock price cost basis. His real cost basis might not be lower. I'm going to show you how I think he might have gotten it even lower. But you can see what he's doing. He's planting a tree for the grandchildren here. He's an octogenarian as I speak. We might be speaking about a man who's passed by the time you see this recording. He is not a young man anymore. And you can see obviously that this stuff really benefited him during his life, but this is for Berkshire Hathaway. This is for the next future investors, and they'll continue to say, hey, what if Apple gets to 1,500? Like we went from $2 to 50 here. Maybe Apple goes from 200 in his cost basis, or 44 here. And so, we look at the future price. Maybe Delta's $200, maybe Kraft Heinz is 120. and they grow from this cost basis up to this. Well, his cost basis remains the same, of where he got these at, right? And so, it's interesting. If you bought Apple at 200 today, or you bought Delta at 50 today, or you bought Heinz at 31 today, or 25, or wherever it may be, if the future price goes up to here, your theoretical dividend gets higher, and the company dividend, if it remains close, your investor yield goes up. Now that's complex stuff, so let me explain a little bit how this works. It's not a guarantee. What happens is right now Kraft Heinz pays a company dividend of 5%. So that means if you buy it at 31, they'll pay a 5% dividend. If you buy Delta at $50 today, they pay a 2% dividend. If you buy Apple today, they pay a 1.5% dividend. And that's why people don't pay attention to dividends, is because they're like, well, I'm not going to pay $200 for a stock and only get $1, or what? I mean, what's 1.48 out of that? Like $3, right? I mean, why would I spend $200 on a Jack in the Box here, that the price tag on this thing is $200, and it's going to give me $3 every year? That's not a good ROI. It's only 1.4%. Well, what happens is the company has a goal to increase their dividend. Once they go from a growth stock to a dividend stock, the idea is investors want as much of that earnings as possible. In fact, we'll look at a number here later on possibly that is the dividend ratio, which means how much of the earnings get paid out. So maybe a company earns $10, maybe 7 of it goes out to the dividends, right? And that type of thing. So we want to see how much they pay. And once they become a dividend an income company, they like the dividend to at least be maintained or go higher. So right now at 31, you're getting a 5%. But guess what? If that went to 120 and they kept this company dividend, then your theoretical would go up quite a bit. It would go up quite a bit. So that's the idea, is if you look at it here, right now the company dividend is only paying 2.96%. They're only paying $1.60 per share. But he owns a ton of shares and he bought them so much cheaper. So please understand the difference between a company dividend and a theoretical dividend. If we were to go to dividend.com, let's just do that quickly. Camera here and move it on over. If we were to go to dividend.com and look at Coke, for example, right here, okay, they pay out 77% of their earnings per share. So of the $2.07 they earn for each share, they're paying out $1.60 of it. That's a lot. That's a 2.96% dividend, okay? Well, Coke's at $54 today, okay? So at 54, what's 2.96% of 54? Well, it's $1.60. See that? But what if you bought the shares at $3? You still get the same $1.60 even though you paid $3 for it. That's why he gets a 50% dividend. So the 2.9 is the dividend yield based on the stock's price today, and they're going to do their best to maintain that. Okay, they're going to do their best to maintain that. That's why buying companies early and buying solid companies that you feel you can hold on to for a bit makes sense. Now that means, look, we don't buy and hope, we buy and monitor. Look, if I had a real estate investment and it started to go south, you think I'd just sit there and let the Titanic take my real estate investment south? If I had a business going south, you think I'd just sit there? So this idea of buy and hope and buy for long term, Warren Buffett has sold companies. His original holders are not the same ones he's had. He's added new ones like Apple over here. As recently as 2 years ago, he's added new ones, and he said, you know what, we're getting out of this business and selling these others. So it isn't like it's buy and hold. It's just buy and hold them if they're good. And if they're good, stick with it. Don't be a house flipper in the stock market. You can hang on to these, okay? And I'm going to show you how this can work for cash flow. Is this so? If their company dividend is 5%, right? But the theoretical price, the future prices goes up huge. your new investor yield is going to be a lot higher than the company dividend yield, just like it is here. Buffett's investor dividend yield is at 50. Whoop, let's get that out of there. Buffett's is at 50, even though the company's at 3. Buffett is at 19, even though the company's at 9.98. Buffett's at 10, even though this is 2.34. And Buffett's actually upside down on this now because Kraft Heinz has had problems and fallen. And he went into, the Kraft Heinz is important because he went into his investor meeting and wrote a letter and he said, guys, we screwed up. So let's talk about Kraft Heinz, and let's use this now as a basis for what we're going to try and learn for. Let's start our story with Kraft Heinz and learn about getting closer to zero with the dividend. So let's go ahead and move this over here and just tell a little bit of that story. You don't need to tell the whole thing, but just go back to 2015 where they made the merger. So Berkshire Hathaway, Buffett owns a bunch of Heinz, and they say, hey, this Kraft company could be pretty cool maybe to merge with. I mean, after all, it's not just Kraft macaroni and cheese, man. They own Weight Watchers and Kool-Aid and what's the other juice box? Capri Sun and Velveeta cheese and Philadelphia cheese and Grey Poupon mustard and Jell-O and Ore-Ida French fries and Oscar. I mean, there's just Oscar Mayer, tons of brands, and they'd be the third largest food company in the U.S. if this goes through. So Buffett's cost basis is not 70. He already owned Heinz, so his cost basis is going to be 30. And he helped arrange this merger and all this and had his 2 cents. And so it starts, gets back to about break even in 2018, and in late 2018, early 2019, they start to have trouble, and then you have this gap, and that's where it got my attention, is in this gap right here. And so let's pull this off, and let's bring up the gap. And we looked at this in the technical analysis section where we said, well, look, here's a gap down with GameStop. We shorted it and did great, made a bunch of money. Here we had Coke gap down. It filled the gap, made a bunch of money. And the question is how do you tell, this from this? How do you know when this is on sale and then this one's about to dive, right? Well, the answer is you don't know. But the way I made these decisions is on the fundamentals. And so we have a technical move with a gap pattern where we can often fill the gap. And I'd say there's a 50% chance that if you were to look this up today, after this video has been made, that it'd be lower than here. And there's about a 50% chance it'd be higher. It's a coin flip. It really is. So I'm going to lean to this side, and I'll tell you why. If this thing can recover and do well, and fundamentally, I don't think it's as bad as it may seem, because everyone is saying Kraft Heinz is doing terrible because of the stock price. Certainly, the earnings haven't been perfect. But my question is, 30 years from now, I would say it's over 50% that we're still seeing ketchup on the restaurant table that says Heinz on it. And there's still going to be, people trying to use Weight Watchers maybe. But Kool-Aid will be around, I imagine, and Kraft will be around, I imagine. And, we're going to wish we were an Oscar Mayer wiener. And so I think that, to get this closer to zero, so let's remember what we're trying to do here. Cost basis, right? And if Heinz is the type of I just don't, if we don't think they're going out of business, cost basis, remember that limit where V initial goes to zero, that gives us an infinite percent ROI. And so that's tough to ignore. So we're going to have risk management, and we're going to get into this on that basis of getting closer to zero, number one. So what happened next is, why did this gap down? That's the question we got to know, is why did this gap down? Well, the SEC started a formal investigation. Now, usually the way this works is they start with an informal investigation that no one has to publicize. It's informal, it's secret. The company doesn't have to tell the shareholders about an informal investigation. But once it becomes formal, they are obligated to do a press release and say, hey, the SEC is investigating us. That's where you have a gap like this. Like, okay, if there's smoke, there might be fire. The second thing is they brought in a new CEO, and that usually doesn't happen unless there's problems. I loved that idea. And then they had what we call impairment costs later on, and those don't bother me too much, at least not yet. And let's explain what impairment cost was. And they're probably going to cut some jobs, I'll bet. This is what I think will happen in the future. They'll probably have more impairment costs, so they'll cut some jobs, and they'll have more impairment costs, and they'll probably have to cut their dividend a little bit. Now, with the dividend, I'll tell you what I like about this dividend. So that's the story, right, of where we are on this. And we're just going to use this as a case study to just show people, how you might, at least how I think. I'm just sharing my experience with you about how I think about this. So here's the question. Fundamental analysis is about studying this income, expenses, assets, and liabilities. Remember that from fundamentals? And so here's what's interesting is the SEC is going to find stuff, and what that means is they're going to clean it up. There was a big fight between two really, Carl Icahn and, these guys got in this big fight over a network marketing company. What in the heck was it called? Nutra Life or whatever it was. I shouldn't tell stories that I can't remember. Hang on, I'll remember what it is. Give me a second. Look it up. It was Herbalife. And they're a big network marketing company, and Bill Ackman tried to pull a short and force it down, and Carl Icahn hates him, so he started buying it and driving the price up, and it was this big fiasco. And the bottom line is the SEC came in, and they looked at Herbalife, and they said, yeah, you guys have done some bad stuff. Pay us a bunch of money. And they slapped them on the wrist. They said, fix it. If you're not going to throw Herbalife in jail, you're certainly not going to throw Heinz in jail, I wouldn't think, right? And so this SEC thing will just force them to clean up their books. This new CEO will probably clean house. Let's talk about what an impairment cost is. And this is very important because while their earnings have dipped a bit, 8, 9%, whatever it is, their earnings have dipped a bit because, people are being more health conscious and they're going to feed their kid carrot sticks instead of mac and cheese. That's a legit thing they've got to figure out. But I just don't see their ketchup and, Oscar Mayer wieners going away anytime soon, right? And so let's talk about what an impairment cost is. If you have on your balance sheet some branding, and let's say that you went out and you were going to get a book, and you're going to say, okay, I'm going to list the value of everything in my garage. So you say car. Right, car, and car is $50,000, let's say, and you say I got my boat in my big garage, $25,000, let's say, whatever it is. You've got your four-wheelers, $7,000. You've got your Harley Davidson motorcycle, $30,000. It's a real nice one. And then you got your mower, and you just start listing all this money, right? Well, at the end, you'd say, all right, here's the total value of what I have. And they call that book value is what it's called. And so, what is a brand worth? What is just the brand Oscar Mayer worth? What is the brand Weight Watchers worth? Well, you put a worth on that, and it's you don't know what your car's worth till you sell it. You don't know what your Harley Davidson's worth till you sell it. So this is a guess. It's an educated guess. It's an opinion on what it might be. So these impairment costs simply said, look, this is what it used to be, and it's billions and billions less of what we thought it was. So in other words, the value of the asset column is reduced by, a significant amount, billions of dollars. But what that says to me is that doesn't say anything about the income. And the income might have slipped a little bit, but it doesn't bother me because I don't own the house yet. It really sucks if you owned it and then it's here, but I don't own this garage yet. And if you go through and say, you know what, Andy, I was wrong on this, wrong on this, wrong on this, wrong on this. Here's the new number. Well, now that's more appealing to me because it looks like they're cleaning house. And it also looks like this investigation, is going to go better if they, maybe this was one of the problems they had. If they cut jobs, that just raises the cash flow or the earnings, right? And they clean out a little bit, maybe some more impairment, a few more adjustments to this. And this is the one I would frown on. The reason I'm interested in this is because as a cash flow investor, I want a dividend. Well, let's take a look at that dividend for a moment. Okay, let's take a look at this. These guys have something called a payout ratio. Let's bring that out and make it a little bigger. And their payout ratio is 43%. So their earnings per share was like, $3.71. Well, $1.60 of that is going out to the investors of what they earn, about 43%. So that means they got a lot of room in there. This is a very easy dividend for them to pay because they're not paying out so much. And as a dividend paying stock that's owned, has Warren Buffett has a lot of shares, they're going to want to keep that dividend going. So they may or may not cut the dividend, but long term, they want that higher. There's no question. They want that dividend higher. So what is exciting is even if this continues to fall a little bit, what if we could have a strategy that helps pay us to buy it cheaper and cheaper and cheaper if we think it can get out of the woods long term? And maybe we're out of it right now. As of this recording, I'm recording now. You might be watching it 3-4 years from now. We might be out. It's a 50-50 chance, but it's really a good example to show how we might think. So that's where it is, right? And we see, okay, they're paying out this $1.60, and what did we say this was? $3.71. They're paying out $1.60 of it right now. That might drop a bit, but I'll tell you, that's pretty impressive. I like that idea. So let's take a look at how we might do this. Remember, once again, is that V final minus V initial divided by V initial gives us our percent return on investment. And if we do that little calculus thing where the V initial goes to 0, that gives us infinity, doesn't it? So our job is, look at this, it started at 48. Now here it looks like we can get it at 35, and it's continued to trickle a little bit lower with all these problems. What if we just watch this go down and we can get it even cheaper? And here's a way we could do it. We could start making promises. And here's how this could work. In our asset column, let's say we start with around 30 some odd dollars. Let's just call it 35 right now. And believe it or not, with $35, we could promise to buy a share of this. With $350, we could promise to buy 10 shares. With $3,000, we could promise to buy, or whatever it is. So 35 would buy 1, $350 would buy 10, $3,500 would buy 100, and $35,000 would buy 1,000. Whatever you want to scale up to. Well, we're going to get into puts and calls here, but right now let's just keep it simple. And you can just trust me. You don't need to know how or why this is. But what if this guy over here had some Kraft Heinz Corporation? Okay, what if he had some? And what if we said, hey, we will make you a promise. This is you and I, or us, right? You and I, we're right here. What if we said, look, we'll make you a promise to buy this off you, no matter how far down it goes, for 30 days, and we'll do it if you'll give us some cash. What if he gave us like $1 to do that? That would take us down even lower, wouldn't it? And if it went down, great, he'd sell it to us. And if it went up, great, he wouldn't. And we just do it again and try to get that cost basis lower. So let me show you what that might look like. So as we contemplated, we're going to redo, the 4 pillars of investing. What would be a really good case study that would be real to show whether it works out or not? How would you show, the reality of how we would do this? So back after it fell right here in March, April or February, March, right around here, we thought, let's use Kraft Heinz as an example of what we want to do. So watch this. Bam. Now let's follow this green line right here. Let's follow. I'll get as close as I can. So this is about $32.50. and we said, look, we promise someone to buy this at $32.50, and they said, we'll give you $1.22 for that promise. So look at this. We just earned $1.22. So think about that. If we wind up buying it at $32.50, well, we've already gotten paid $1.22. So see, our real cost basis now is at $31.28. Now this is going to be a 4-pillar strategy called the naked put. We're not going to go into the detail right now. You're just going to have a little trust in your teacher that we clicked a button. We had the money in our asset column. We clicked the button. We said, hey, give us this 122. We'll take it in cash flow. We'll take it as income, and that will reduce our cost basis. Now what's cool is if it goes below that line and ends at expiration on April 19th here, 2019, if it goes below that, then we'll wind up buying it and we'll pay that cost basis. But that's a pretty good cost basis, $31.28. And then later on, I'm going to show you how we take it down even further. But if it's above there, we just keep the premium. So if it's below it, we buy it cheap. If it's above it, we keep the premium. Okay. Now watch this. This is not a 4-pillar strategy. This is an ultimate option strategy. And when I said earlier in our disclaimer that we're going to use some of this stuff for illustrative purposes, this is what I mean by that. This is not a recommendation, education only, illustrative purpose. And I said I would tell you when we're going to do advanced, crazy, risky stuff. Well, here's some advanced, crazy, risky stuff. We also promised to sell it at 35. And that's a naked call. We do not do those as beginners. It's just that simple. I can't tell you what to do and not do, and I can't recommend one thing or not, but I will tell you that this is considered probably among the most aggressive things a person could do. But so why show it? Because I'm going to illustrate that if I can make a promise and collect $1.22 here, and I make another promise and collect 88 cents here, that's a total of $2.10. That takes the cost basis down to $30.40, right? Well, it landed between those. I've done some work with some of Robert's friends on a trading strategy he asked me to help him with that they call the cash flow zone. And this is very close to that idea. So it stays in this zone, and we just collect the cash. Now, right here, we decided to do another call, brought another 50 cents. It stayed below, so it expired. We still haven't been able to get it yet. Okay, here we had some hope because it dipped below. And notice the green line is at $30 even. That's where we promised to pay it. We've got our $30 right here to buy this share. And of course, you could do 10 shares for $300 or 1,000 shares for $30,000 or whatever you wanted to do. 100 shares for $3,000, whatever you want to do. And it almost made it down. Now think about this. If we promise it at 30, and we take all this premium collected, which is now up to $3.12, our cost basis is now in the 20s. See this? And I'll be darned if we couldn't get it there because it came back up and expired. So we're trying as hard as we can to buy this and having a hard time getting it low enough to buy, but we're collecting cash the whole way. Decide to go another 71. See how that drops down yet again? So now we're honing in on 25 bucks. Here we get another 30 cents. On a put, and then here we get another 98 cents on a put, and we'll see where it goes from here. Now that's $5.11. So check this out, okay, from cost basis. Let's pull this over here a little bit and let's realize a few things. This thing started at 48 bucks to own Kraft Heinz. It falls to 36 and gets our attention. We take it down another $5, then it falls down. We've taken this down. It's now at our agreement to buy it at what, 30? So we've agreed to buy it at 30. So that's another $6. So we're down here saying we'll buy it at 30, and then we get to take it down another $5.11. Which means our actual cost basis would be $24.89. $24.89. So effectively, we've been able to take this basically 50% off, halfway to to that 0 point that we'd really like to get to in cost basis, where our cost basis is 0. Halfway from where it was right here. A lot of it came with a nice gap. Another bit of it came with a little trickle down, and then another $5 came because we promised to buy at this level. So if it dips below 330, which it looked like it might, it's going to have more problems than not. Eventually it's going to dip down low where we can buy it, like down here. Our cost basis will be under $25 to buy this. So the lesson is not what happens to Heinz after this. I don't know what's going to happen. If it goes bad, we're going to talk about this again in the risk management pillar and what we're going to do to get out of it. But right now, being able to get it that far down and that cheap and own all of those brands as a value investor and say, you know what, would I like to be the owner of the Kraft Heinz company? Do I think 30 years from now they'll be doing ketchup, or 10 years or what have you? And can I get that cost basis down even further over that time? I believe the answer is yes, I can. And so I'm going to show you how we'll work at this in another part when we talk about calls and covered calls and how to keep chipping away at that cost basis. But for right now, that's pretty cool. So look at this. If they pay that dividend, if we buy it here, and then they announce the ex-dividend date, around, this is going to expire 16th of August. Let's say we own it and the ex-dividend date is maybe August 20th. And they'll probably keep it for the foreseeable, they're going to pay out that 40 cents, for a little while longer. They've got that great payout ratio. Where they've got enough room to pay this a little longer. I expect that dividend will go down, but are these things long-term or temporary? And so before we look at the two scenarios, there's also some important stuff, from Warren Buffett and what he has to say about this. And I happen to agree with him right here. We won't worry about, this is some of the problems they had. Operating results of the investee. In other words, what has gone on here? And you'll notice that Kraft Heinz has not experienced a series of operating losses. Previous reported cumulative pre-tax earnings over 3 years, earning were approximately $14.7 billion. Heinz has disclosed its intentions to divest non-core businesses and deleverage its balance sheet. So they're going to sell some stuff, sell their lowest performing stuff, and clean that up. Heinz continues to own a large number of brands: Jell-O, Weight Watchers, Capri Sun, Planters Peanuts, Oscar Mayer, Ore-Ida potatoes. And here's where I agree with Buffett. We believe that those brands can produce considerable earnings in the future. We think we can figure this out. If you have brand recognition that is that strong and you're having problems, hey, we can figure it out. And these are money makers. These are things that people like to buy in the store. Now, this is really important. Heinz reduced its quarterly dividends from 62 to 40 in 2019. Now, I'm not concerned about that, because 40 cents times 4 quarters, that's $1.60 over a year. And the reason they've taken that down is their stock price is so low. And they've wanted to pay out about 5% on that or so. So this will probably go down a little more, but here's the big thing. Berkshire received a dividend of approximately $130 million in Kraft Heinz in 2019. Would you sell, so here's this Jack in the Box producing $130 million in dividends. Okay? If the price of the Jack in the Box fell, but you already owned it and it's still cash flowing, who cares? Well, if you had a house that was renting for $2,000 a month, and the house was at one time $300,000 and it went down to, say, $250,000, but it's still giving you $2,000 a month, who cares about the value or the price of the house? This is called the Cash Flow Academy. And so here's what I really agree with Warren Buffett on. While lower than in recent years, such dividends are significant. And here's the deal. They demonstrate Kraft Heinz's ability to generate cash flow in the future. And what that means is two things. All these brands can still produce earnings, and they're still their payout ratio is really strong. They have plenty of earnings that they can apply to fix business and still pay out a dividend. And if they lower the dividend temporarily, I'm okay. So basically, this is really important, okay? This is not necessarily a big loss in value that is anything other than temporary. So if this is temporary, and we like the idea of filling gaps, if this is temporary, from a price standpoint, we fill the gap. And they're going to want to keep their dividend in line with their price from a percentage basis, what they call a dividend yield. This is a great opportunity, possibly. And if it isn't, that's fine. But I would rather be, on the ground wishing I was in the air than in the air wishing on the ground most times. But I'll tell you, I would feel terrible if this got back up here and the dividend got raised and I could have got this thing at a cost basis of $24 a share, under $25. If my cost base is under $25 and I can get a dividend, that's going to be ridiculous. So look at this. If we buy this month, which it looks like we'll probably buy it at 30, but our cost basis will be just below 25 here, 24.89, and it could it's just due to drop down and get there. Well, the company dividend yield sitting there at 5%. Ours will be at 6.43. So we'll always already have a better investor yield. So just like on Coke, the company dividend yield is 2.96. Buffett's is 49. Why? Cost basis, closer to zero. The company dividend yield 98.98. Buffett's is 20% here. Why? Well, lower cost basis. So as these stocks go up in price, the dividend, the amount of dividend yield, hey, 2% on a $200 stock is a lot different, right? And so this is called cost basis, and looking at cost basis and dividend, and that's the lens we're looking at this through. So we're not really looking at this to buy low and sell high as it fills the gap. We're just saying this might be an opportunity to pick up a pretty strong company in terms of brand recognition and earning power as they clean house. New CEO, probably cut some jobs, probably go even further, but we feel good about hopping in at that number and then continuing to reduce the cost basis. Now here's what's really interesting on the other side of this. Let's move this over here and get rid of this. And let's say on the one hand, we might own it. And we might be getting this dividend now. So we'll have this little jack in the box that pays us $1.60 if it holds each year. And that can go up from there. And we'll keep working on getting our cost basis even lower and driving the investor yield higher. We don't really care what the company dividend yield is. We care what our investor yield is at our cost basis. We like to drive that lower to drive that higher. It's that simple. The more we drive this lower, the higher this will get. So watch this. Let's say we don't buy it this month. Okay, that's fine, but think about what we've done. We had to have about $30 in the bank to buy that share of stock, right? Or $300 for 10, or $3,000 for 100, or $30,000 for 1,000 shares, right? So which should really be nice, because if you think about a $30,000 down, and you got 1,000 shares, that's $1,600. That's pretty cool, right? That's pretty nice. But here we go. Look at this. We've gotten $5.11 out of that in the last 5 months by just keeping it there, in the bank, so to speak, but just by having it ready. So check this out right here. $5.11 divided by $30, the amount needed to keep our promise and buy it. Let's do that again. $5.11 divided by $30 is 17%. Now that's only for 5 months. So if you annualize that, let's just pretend it was 6. It'll be a little higher, but let's just pretend it was 6. If you annualize that, it's going to be more than 35%. Okay, so we'll call it 34 here. That's 34% on our money annualized over this half year by just promising to buy this cheaper than it was. and collecting these premiums. Okay, this is what we feel is pretty smart. Maybe other people might disagree, but we like that idea. And so that's very, very exciting that if it doesn't dip down finally and we purchase it, we'll do this again, and that number will get, this number here will get even higher and higher and higher until finally it dips down far enough that we buy it and we get a ridiculously low cost basis on it, and we go from there. So, before we get into, more about paper assets and, more about what stock is, this is a nice introduction and a good follow-up to this idea that we had here. Where'd it go? Did I lose it? This idea we had, here we are, right here, of getting the cost basis closer to zero. Remember that? And the leverage to increase rate. So hopefully that's a good follow-up to that idea as we went more and more and more premium brought in to drive our cost basis down here in this latest month to under $25. This thing can fall to $25 on other bad news and we'd be absolutely still fine. It can even now go down to $20 because we don't care as long as we're in it low and we can continue. I'm going to show you, we're going to come back to this, and we're going to see if we can get our cost basis on Heinz even lower to find out in the next couple of weeks whether or not we buy it or don't. By the time we get to the next pillar, we should know, and we'll take it even lower. And then by the time we get to risk management, we'll do a risk management strategy on it. So hopefully you can pick up some shares here, and hopefully this is fun. Hopefully we're making this simple and real. What should you understand? What should you not worry about? You shouldn't worry about the details of how we got this money yet. Just understand that we did, and focus on the idea that, okay, if there's one thing I can have you understand right here, it's this idea right here, that if we can take this initial investment lower and lower and lower, our return gets higher and higher and higher. You see that? As this gets lower, this gets higher. As this gets lower, the percent gets higher. As this gets lower, the percent gets higher. If you understand that, we have a great foundation to close out this segment with this Kraft Heinz example, and this can be applied to other stocks. Okay, and so that's what we'll do. So hopefully this was cool and exciting, and your temperament's right, and you say, hey, this is a pretty cool mathematical idea. And guess who I got it from? I got it from Warren Buffett. He's the guy that started doing this with Coke in the 90s, and this is how he would reduce his cost basis on buying Coca-Cola in the 1990s. He started in 85, I think, or mid 80s, and then in 1993 he started doing this strategy that I'm showing you here, and it helped reduce his cost basis on his Coca-Cola shares. So with that, when we come back, we're going to start talking about, hey, what is stock? What is this? And we're going to use Coke for an example here and see if we can't figure out some ways to enter, some charts, and how this gets all put together. Cost basis, that's what this segment was about. Cost basis to get a higher investor yield on a dividend.